Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly housing market update. Just wanted to get into some of the details here with you. Let me just share my screen and get right into this. Okay, so one of the big stories is we want more inventory to stabilize pricing, which we did get an influx in inventory over the summer. Things weren't moving quite as fast as people wanted to because of higher elevated interest rates. So the housing permits cycle is low right now. Housing permits have reached their lowest point in the current cycle, signaling potential economic weakness. And housing starts beat estimates. So the housing starts beat estimates, but the upcoming year to 2 year point as far as new permits and builder sentiment is low. Warren Buffett just put a bunch of investments into new home sales, so it's kind of a mixed emotions on a lot of people in the market. They don't know what to make of it. But actually, it's pretty simple because we kind of know what's coming around the corner, and that is that we know that we're going to see most likely, unless something really changes in the market, a lower interest rate, forecast in the future over the next 6 to 9 months. So, despite permits being low, housing starts exceeded expectations, driven largely by volatile multifamily construction. Okay. Mortgage rate impact. We have the builders can sell homes when mortgage rates approach 6%. So right now, we'll talk about it more, but we're kind of in the mid sixes, give or take a little bit, depending on the day and the week. And with the recent rate slightly below July levels, boosting new home sales applications. So, in other words, once we get down to six, some say below 6.4, but once we get down to about six, we know because it's happened a couple of times, we see an increase in builder sentiment, permits, and with traffic, and also with mortgage application data, which has been up, which I've talked about many times. It's been kind of flat the last week or two, but basically this is new inventory, right? That comes from the builders. As 75% of resale homes are also going to be buyers. So they're also seeing backlogs in homes. Right now they're sitting at about 10 months supply. Usually anything above 6.5 is not good for the building sector. Now they're going to be fine. Their margins are a little bit lower because they're giving away a lot of concessions. They're having price reductions and those sorts of things. But the builders just aren't going to build, more homes in order to, keep up with, what's needed to keep the prices flat or stable. So, because of all the money they're having to give away for these concessions, buying down interest rates. And you can walk into many builders today and get 3.9% interest rates. You can get down payment assistance programs, all those sorts of things. If you have any questions about that, I'd be happy to answer those and get into that and who's offering what. Every builder is going to be a little bit different, but there's been a 4 month declining residential construction labor. This is a big thing that we always talk about. We've had a decline in manufacturing over the last year, the last 4 months. We see a decline in residential construction labor, which is not good. And that, these sorts of things with Fed policy, obviously affect this sort of thing. So it's, with their restrictive policies right now and their Fed rate being at 4.2 to 4.5, indirectly affects mortgage rates with the bond market and 10-year and 2 year treasuries, especially the 10 year and the spreads between that and mortgage rates. Now, the spreads have been getting better. If the spreads weren't getting better, we would be north of 7% interest rates right now. But the spread between the 10 year and the mortgage rates have gotten much, much better. So that's good news. But the residential construction and manufacturing, when that goes down, that happens, ahead of every recession. So something to keep an eye on. We're definitely going to watch that. Obviously, they're going to have to ramp back up. The Fed, many keep saying that the Fed is way behind the curve on doing rate reductions. Scott Bessett just came out this week, saying basically what we've been saying, and Logan Moshami over at Housing Wire, Barry Habib at MBS Highway, just to name a couple of economists. That they should be at a more neutral policy. That would mean 2.5 to 3.75 on the Fed rate. Right now they're at 4.2 to 4.5. So we'll see. Tomorrow is a big deal because it's the annual Jackson Hole and Fed Powell, the chairman of the Federal Reserve, is going to be giving some remarks there. So that'll be interesting to watch. But that'll kind of maybe give some idea, especially after our dismal labor numbers that were revised, where he sees things heading, because he says labor overinflation, even though before that it was, we follow the inflation data. And before that, he lowered the rates in a period of time before the election that kind of have people scratching their heads, because it makes more sense to lower the rates now than it was then, as far as inflation and the weakening jobs market. So we'll have to watch and see what happens there. But it's definitely a unique cycle. As mentioned here, unlike past cycles where permit starts and labor fell together, current AI-driven data centers, construction, and large fiscal deficits, Social Security, Medicare, are propping up the economy, complicating the recession signal. So we keep tracking it. Recession red flags, key indicators. Again, the 4-week moving average jobless claims, if they reach 323,000, we're definitely going to see an issue there. Now, by September, October, probably by October, we may see some of those government jobs that were lost come into play. But will it be enough to move the needle? Probably not from just that standpoint. But the Fed, part of their mandate is full employment. So the Fed rate, I feel, more than the tariffs or anything, is definitely holding back the residential construction and commercial construction, because and even manufacturing, because companies have to borrow money or try to refinance, and if they're not able to do that, they're not able to put that money into production. They're not able to put that money into job growth and raises for people who are already working there. So uh, we'll see how that goes with that negative report we had. That should definitely move the needle. Right now everybody's planning on at least a 25. Some are saying 50 basis point cut in the September meeting by the Fed. We'll see how that goes. I think that if they do 25, maybe even 50 basis point cut on the Fed rate, it may not even be enough to move the needle on, for the bond market, because they're already way ahead of the Fed. So it may not affect the 10-year Treasury that much, and won't affect mortgage rates much, which is what happened several months ago, when they lowered the rates before, and everybody was like, well, why they lowered the rates? Why isn't the bond market reacting accordingly, and why aren't mortgage rates going down? Well, because the bond markets was ahead of the Fed then, they're ahead of the Fed now. So I think it would take about 70, really take at least 50 to 75 basis point cut to see a big reaction there. So we'll have to wait and see, though. You never know. As the spreads get better, we'll keep an eye on that. In reality, though, we should be at more of a neutral policy. Scott Bessett was calling for, not in one foul swoop, but we should be, heading towards that more neutral lowering of, a total of 150 to 175 basis points to a more neutral policy. Only about 7%, by the way, of what the builders use as far as imports are concerned, only about 7% of those imports go into the building process. So a lot of times you hear people say tariffs as far as residential construction is concerned. It really isn't that large of a portion of what it is that goes into these building projects for new, fresh inventory. So just something to keep in mind there too when you hear about the tariff hysteria that's out there. So U.S. consumers spending remains strong due to 2010 qualified mortgage rules. Had to be pre-qualified to buy a home, and the 2005 bankruptcy reform laws reducing middle and upper middle class delinquencies despite rising credit card and auto loan issues. Now, of course, there's also this idea too that we have, people have much more equity than they did back then. So that's another big thing. Many people even own their homes outright now. So a lot more equity out there for sure. Um, the we're gonna talk more about this right now. This is interesting. The the Trump official says DOJ will investigate Fed Governor Cook. This is another Fed governor who's under investigation for mortgage fraud. According to the alleged allegations from Bill Pulte, if you go on X or go online, you can see her signatures that have been put out there for the public as part of the public record. This article here talks about all this, and basically it says that when you go to buy a second home. You have to, say which one's your primary, which one is your, secondary home. When you apply for that second mortgage, you're going to pay a higher interest rate. You're probably going to have a higher down payment too on that second home because the lending institutions are taking a greater chance on your loan. So that's just something that is happening right now. I wanted to point that out. We'll see how that goes. Right now, it seems like Powell is backing her up. I don't know how you back up somebody who's got their signatures on those documents, and it's pretty clear cut from what we can see yeah, on that. But we'll have to wait and see how it all shakes out. She says she's not resigning, so we'll see what happens there. Neutralizing the Fed involves pressure with the governor. So this is. Right now there's was it 10 or 11 different people who've been put out there to the public from the Trump administration on who they're looking at for the next Fed chairman. We'll probably see by the end of this year, definitely by the beginning of next year, who it is that they're going to pick to replace Jerome Powell, who's going to be out in May. But part of the strategy here would obviously be the idea that they want more people out there talking about, the Fed being antiquated in their approach and their models and being completely data driven rather than forward looking. They're looking in the rearview mirror. One of the big components of that would be shelter costs, which can make up, PCE inflation like 16%. CPI can make up as much as 36% of that data, and that it goes by what rents are going by, and they do a survey where they'll call you and they'll ask you how much you think you could rent your home out for. Well, most people probably don't know that off the top of their head, but that's the way they do it. And of course, we had the big shakeup in the BLS numbers too, which had to do with those jobs numbers we talked about earlier. So we'll see how it all plays out over here in the next couple of months. I think we're definitely going to be going into a rate cycle here really soon. Jerome Powell is going to have a really hard time. Tomorrow is a Jackson Hole meeting. Like I mentioned, he's going to have a really hard time after that dismal jobs numbers that came out by not kind of signaling that we're going to be heading to a rate cycle. Everybody knows we should be heading to a rate cycle of lowering the Fed's rate. So we'll see how that all shakes out. So with that, the Phoenix numbers, there is a little bit of a foreclosure spike. Nothing to get too crazy about. I'll show you some of the other numbers here in a minute on that. But I got to keep in mind when you hear percentages and stuff, it's you have to look at the context of the percentages. But the Cromford Report notes a rise in trustee deeds in Maricopa County, with 136 recorded in July 2025, 121 residential, the highest since 2019, up from 31 previously. Now, remember, during the pandemic, we didn't really have any foreclosures, right? Because there was a moratorium put on that and all kinds of programs to help offset that period of time. and what was going on there. But the notice of trustee sales, 372 notices recorded in July 2025, up from July of 2024, but stable over the past year, indicating low serious mortgage delinquencies. The foreclosure process, Arizona allows 90 days. Again, it's different in every state, but Arizona allows 90 days after a notice of trustee sale to resolve payments before auction. Many homes are reverting to banks, 84 in July, rather than third-party buyers at 47. So distressed properties, approximately 1,600 distressed residential properties and 379 REOs bank owned. Okay, if they weren't sold during the auctions in Maricopa County as of August 1st, 2025, that's up 49% and 120% respectively year over year. Now, keep in mind, we were up to, what was it, 26,000 homes for sale recently. We're down to about 23, 24, give or take, depending on the day and the week. But so it's a low number overall, but they're just bringing up the concern of the rapid rise in trustee sales despite low delinquency rates. Suggest homeowners struggle to sell because homes are sitting longer because of these higher rates and the policies of the Fed right now, and avoid foreclosure due to market conditions. So the outlook on that, increasing trustee deeds may lead to more distressed sales and tend to monitor as it could signal broader market distress. So uh, this was an article that just came out from The Economist. America's housing market is shuddering. Okay, and basically, just to kind of sum this up, there's a market slowdown. The U.S. housing market is described as shuttering with price declines in the West and South. So, the Western United States and the Sun Belt in the South, particularly Phoenix and Dallas, where home values dropped a few percentage points. More with when you figure in inflation. Logan Motoshami put out for his housing forecast of 2025 was 1.7%. Um, increase in prices. So, the we're definitely seeing, people struggling to sell their homes a little bit more. Again, every area is going to be a little bit different. And we'll talk more on the numbers here and where we're heading. It's definitely something that's changing, I think, rapidly also. But prices in are rising in the Northeast and Midwest. So where do we need the most inventory? It would be up in those areas as far as new builds go. But there may be also less land to build on than there is in the West and some areas of the South, right? So it's kind of that mixed bag for new, fresh builder inventory. Okay. Uh, but it's falling in Florida, down 4% from last year on prices due to high insurance premiums, reduced Canadian buyer demand, and new safety regulations post 2021 Surfside collapse of the condo over there in Florida. So Phoenix, as far as Phoenix is concerned, year over year price declines of in general for the greater Phoenix area, 3 to 4%. Again, some areas are doing okay, some aren't. But overall, it's pretty flat or down. Since March of 2025, list prices also decreasing, reflecting softer market conditions. Definitely a Canadian buyer impact. Phoenix has seen a reduced Canadian investment, with many Canadians owned homes sold and limited reinvestment. The monetary policies, obviously, you know, making it tougher for builders and for first-time home buyers. I think we're at the lowest rate of first-time home buyers in decades, and we've talked about that before. But right now, again, there are ways to get lower interest rates, whether it be assumable loans where you assume somebody else's lower interest rate. You can get buy down programs from builders and sellers in order to buy down the rates. There are down payment assistance programs. So there are a lot of solutions to this issue rather than just running out there and just thinking you got to pay, the full interest rate or the full pricing. You can get a lot of good deals right now as a buyer. But I think we're gonna talk about this in a minute. I think we're gonna see that head in the other direction. But currently, interest rate being around 6.6% for the 30-year fixed. It's down slightly below 6.4. And if we get below that 6.4, many people are saying we'll see lower rates. I think if we get more towards 6, we're going to really see demand pick up. Not that it's going to go crazy, but we'll also see more building going on, and that'll be good for pricing. So um, the list prices, average list price per square foot is lower in 2025 compared to 2024 in the Phoenix area, with an earlier seasonal dip starting in April. And the market conditions, Cromford Market Index. We'll take a look at that in just a second. So one of the other things I had mentioned to you was the 7%. So keep that in mind when it comes to the tariff hysteria when it comes to housing anyway. And as far as the report goes on the tariffs, there was a little bit of an elevation in the CPI and PPI, but again, a lot of that was in the service industry. So not necessarily so much in imported goods, not only for building and housing, but overall. So um, bond yields rise ahead of Powell's Jackson Hole speech because they just don't know what this guy's going to do. Again, he's called too slow for a reason. Remember the whole transitory thing? Yeah, we'll never forget that, right? It wasn't that transitory, was it? Um, so right now, the 10-year Treasury, which goes hand in hand with the 30-year fixed mortgage rate, is at 4.3. Normally, historically, that should be around 175 to 200 basis point difference historically between the spread between the 10-year Treasury and the mortgage rates. And we also, just a quick look here at the 2-year Treasury, we're at 3.7, which again is crazy with Fed policy being where it is at 4.25 to 4.5 for the overnight trading. So right now, our mortgage rates again are 6.6 for the 30-year fixed is what they usually you'll hear quoted. Again, if you're a VA, FHA, you're going to be a little bit better. 15-year, of course, is better. Um, but it's really interesting. Now we are seeing a drop off in active listings. So you have people who either sold their home or just figured they would wait. Maybe they're taking vacation through the summer, so we saw a little drop off there, or they're going to wait. A lot of people wait till after Labor Day to do that again, or they'll relist, or maybe next spring or after the holidays. So we'll have to wait and see how that goes. Looking at the current numbers, we've got 80 days closed days on market in the greater Phoenix area, 4.9 7 month supply. Again, the builders are at 10-month supply. Um, they definitely that's across the whole country. The absorption rate is 20, which again, that's definitely a little low. We like to see that much higher for the absorption rate. The average list price is 696,000. The average sales price is 582. And the list to sales price ratio is 97%. We usually like to see that at a little over 98%. The week over week active is pretty flat. Right now, again, this says this was taken a few days ago at 24,000. We're just under 24,000 now. Pending pending is up just a hair. And a lot of this is due, which I'll talk more about in a second, is due to the fact that we did have that drop off in inventory. So we're going to see a swing back in the other direction from that standpoint. Obviously, if rates drop, that'll be another thing. Um, Closed units down 3.6%. And then we have, we were talking about the short sales, lender owned REOs and HUD distressed properties. We see the short sales in the greater Phoenix area is down a little bit, HUD's down, but lender owned REOs up 6.8%. But the total number, again, you got to look at the total numbers here at the week over week, 110. So it definitely elevated a little bit from where we've been, but nothing that's crazy except for the rate of increase is what the Cromford people were concerned about. So we'll keep an eye on that. These are the percentages of inventory by price. The largest category would be the 400 to $600,000 range, um, and everything under that. The largest portion being under 800,000 for the total percentages. You can see that a lot of the luxury listings are definitely these numbers have gone down for the most part. There's a little elevation there from the 300 to $400,000 range, which is interesting. But that is a quick look at that, and the days closed on market has actually gone down 3.6% closed month to month and week to week. So interesting how that all shakes out. Now, this shows a little bit more with the pending, that shows just a little bit more increase in buyer demand, which, again, slight increase, nothing crazy, but it may spell things that are to come as we look at um, the oh, where did my Cromford impact go? Let me pull this up for you really quick. My fault. I should have already had that up there for you. Okay. So let's look at this first before we get into the other portion. Okay. There we go. Your supply, so the Cromford Market Index basically tells us if we're in a buyer or seller's market. Right now, for below 90, we're in a buyer's market. If we're over 110, we're in a seller's market. If we're at 100 or within that 90 to 110 range, we're in a balance market. Right now, we're at 77.5. This was down to like 74, so we're heading back to the other direction. Was the kind of the point I was making with the pending sales that we showed you there. The supply has definitely dropped a little bit. Um, and we see the demand has gone up just a little bit. So as we go into this, we'll see, also with each of the cities, we see, except for Tempe and Maricopa, we see them heading into the direction back towards a seller's market. Nothing crazy, but they've definitely headed back towards. And in the last week, it's gone up 8.6% overall, and before that, 6.5%. Um, so it's definitely heading back towards the direction of seller, but we're still, definitely in a buyer's market here below 90, but it's heading back in the other direction. So if these two numbers are the same, it would be exactly 100. So again, we track this every week. We'll keep an eye on it. Right now, you've got Paradise Valley, Fountain Hills, Cave Creek, Chandler, and Scottsdale are technically in sellers markets, barely. Nothing crazy there. Paradise Valley being the highest at 196, and the next one down is Fountain Hills at 127. So they're just barely over that 110 mark. The lowest on that is Scottsdale at 112. And then we've got Avondale, Glendale, Phoenix proper, Gilbert, and Mesa. Those are all in balance markets, but all those markets are heading back in a direction towards seller. Okay. And then Tempe, Peoria, Goodyear, Surprise, Queen Creek, Buckeye, and Maricopa City. Those are all buyers markets right now on the index. And if you want more information about your particular community or area, we can get you that as far as what kind of market you're in. Um, so right now, the contract ratio, this gives us more of the exactly right now what's happening, what's the active listing count, and what's under contract. This has definitely gone up a little bit. When we look week over week, month over month, definitely up a little bit. So we're heading back in the right direction if you're a seller. If you're a seller, depending on whenever you're looking to sell, I always tell people again, it just depends on what, how much equity you definitely need. You have to make that decision. I can't make it for you, but you're always going to either be, typically in a seller or buyer's market, unless we're just in a completely balanced market. where there's really no advantage to anybody. So right now you can look at it as I can get a better deal on what I'm going to purchase, and maybe, not quite as fast of a sale for as quite as much as I thought I might be able to get. Again, depending on your current market in your particular area, zip code, and community, and what your home offers and features and all that good stuff. So, but 32.8 right now is where we are, and we can see the different levels here right now. We're just kind of in that warm market range. Um, so as we go along here, we go across, we're in that warm market range. When we were, in the crazy market of 2021, I mean, we were in insanity range. Okay. But right now, actually, Paradise Valley is pretty close to insanity range, which is pretty interesting and pretty typical for that area. When we look at the actual map, if I can get it back up for you here, you can see a few actually hot areas. Gilbert, and again, we can get you the information on each one of these zip codes, but the other area is Glendale, and that part of Paradise Valley up in here where we talked about. But everything else is pretty balanced to cold for the most part. If you look in the green area here, so that's kind of where we're at right now, guys, on everything. If you have any questions at all about how to get the best deal on a property that you're purchasing, interested in getting a lower rate and working with one of our mortgage brokers, if you're interested in selling your home, want more information about what your home could sell for, what kind of market you're in, we'd be happy to do that. Please subscribe and share this to anybody that may find this helpful. And please go ahead and like our page and post, and follow us for more information. We're also, of course, on Facebook, Instagram, YouTube, and even TikTok. We'll talk to you guys next time.